Mode.
Hey everybody, Preston Brent here with our weekly roundup. This is brought to you by our trader user group. This is for the trading week ending May 31st, 2019, the end of May. All I can say, especially to the news media, is folks, you just got to put the cuckoo back in the clock. I mean, come on. More on that in a minute, guys. But this week we saw the Dow down over 3%. By the way, it's the sixth straight weekly close lower for the Dow. We haven't seen that record since 2011. The S&P was down about a little over 2.5%, 2.6% to be exact. Nasdaq down about 2.4. The Russell down almost 3.37%. And we did see volatility come up this past week about 23%. Closed the week at 1871, the VIX. Last week it closed at 1596, so it's a pretty good little jump in volatility. For the world markets, we saw the FTSE, the London Exchange, down 1.5%. The Paris CAC 40 was down a little over 2%. The German DAX down about 2.3%. The Nikkei over in Japan down 2.4%. And China was the lone holdout. They're up about 1.6%, but they've really suffered this year. Weekly performance-wise, everybody was in the red, even industrials. They were down about 1.91%. We saw staples, which is traditionally a risk-off sector, one of the worst performers for the week at 3.7%. We're also seeing something near term for the utilities as well. I think they're getting a little bit stretched because money's just been going into staples and utilities, especially utilities near term. So we're having some profit taking there, but it's still a risk-off sector. Also, I'm looking at the trailing PE ratio is at 21.66, but the forward PE ratios come all the way down to a little over 16. And just as a reminder, the if investors are willing to pay about a 15 PE, that's a forward multiple, which is very low, that's lower than average, that would put the earnings forecast for GDP or for earnings for the S&P rather this year at about 175 bucks. The forecast right now is about $187. So that would put the S&P at about 2,600 share for the S&P futures if they're willing to pay about a 15 PE forward multiple, which again is lower than average. Keep in mind, as interest rates stay very low, we can have multiple expansion, which would suggest that these assets can be inflated a little bit more than normal, moving them up a little bit higher. But historically, you know, we saw that revision down just slightly, but GDP in Q1 came in at 3.1%. And historically, when GDP has been in the 2% to 4% range, we've seen returns in the S&P generally on an annualized basis anywhere from 9 to 11%. So basically, all of that really means that we can make new all-time highs if the collective politicians can work out these trade tips and money can get back on track. But we'll see where that goes. But like I said, this is the sixth straight weekly close for the Dow to the downside, longest since 2011. And this upcoming month, the month of June, it's going to play a critical role in where we go price action wise, because June 10th, if you guys recall, is the deadline on the Mexican 5% tariffs. And then Trump's going to elevate it to 10% and then gradually take it up to 25% by October. I don't believe that's going to happen because already key Mexican officials are going to be meeting with key Trump officials this coming week into next week to see what they can do. And I think all we need from Trump is a tweet saying that Mexico seems to be taking the bull by the horn, so to speak, and they're looking like they're going to be doing some hard work to curb the border crossing. So I'm going to delay the 5% tariff, blah, blah, blah. You get the picture. And then markets are going to shoot up a little bit. Okay, on that news. And then coming up on June 28th, thereabouts, we got the G20 meeting in Osaka, Japan, where Trump's going to meet Xi. I suspect something's going to come out of that saying we've agreed to return back to the negotiating table. We're going to operate fairly and blah, blah, blah. You get the tweet there. It'll hit the headline numbers, and that'll be good for another 3 to 5% move higher in the S&P. and we'll get that back on track. Although the markets have factored in the negotiations going longer than they should, which is kind of what we've always seen all along. Now, against all of this backdrop, folks, we got the Treasury yields. They've kind of come down to levels we haven't seen since 2017. There's still over 10 trillion in government debt internationally that's still negative, and the U.S. dollar is becoming stronger each day because money is flowing internationally into the U.S. The U.S. has kind of been a money magnet for international money flow. So that is keeping the dollar strong. It's keeping our bond yields on the further end of the curve very low, and the short end of the curve is very low too, because the markets are making a big bet that the Feds, there's about an 82% probability of the way the 30-day Fed fund futures is pricing it out now, that the Fed's are going to cut the rates by 25 basis points. Some are even saying possibly 50 basis points to kick the inflation gauge into gear. We'll see how that works out. But all of that against the backdrop of lower unemployment. It's around 3.6 now. Strong economic data. It's slowing, but it's still strong. And let's not forget the yield curve. It's an inverted. Shorter term rates basically higher than longer term rates. And against all this backdrop, we've got very high consumer confidence. So all of this has kind of confused Fed officials. I mean, but not only is it confused Fed officials, I'm telling you guys, we've even seen the news media, and I wouldn't even classify it as news media anymore by the ranting by a lot of these crazy loons on TV. It's just unbelievable. But they're touting now China contemplating a ban on exporting rare earth materials to the U.S. I mean, come on, forget about this. It's a non-issue. We can get rare earth materials anywhere. We've been getting them from China because it's the easy thing to do. And remember, China banned them back in 2010. They cut the exports by about 70%. Nothing ever happened. Nobody even talked about it. And we quickly started finding alternative suppliers, and then China relented. So it's just a news media item more than anything else. I mean, literally, keep in mind the news media, they're just all about ratings, you know. And to listen to these bastions in the press, you'd think the world's going to end. And, you know, kind of reminds me, if they could figure out a way to create an event that could end life here on this planet as we would know it, they'd do so. And they'd do it for the ratings. You know, that's about all they're good for. So I listen to them for entertainment and just to see what's kind of cooking in their little pea brains. But that's a little bit about all I know right there. Keep in mind, folks, markets run on emotion and a general adrenaline short term. So the market, the media knows this. So they can, it's like kind of controlling a 5-year-old kid, putting a candy bar in front of them, and just as they reach for it, you pull it back again, and they start screaming and moaning until you put the candy bar back in front of them again. It's just, you know, this is rocket fuel for rat brain traders, and that's how they tick, right? But as I say, put the friggin' cuckoo back in the clock, and we got to think more like traders. There's a lot of great opportunities out there laying in wait for us if we know how to exploit rat brain behavior and turn it into profits. And that's kind of what we're all about here. As our members know, who've been following us for quite some time, that's our approach. It's the only way to really build true long-term wealth. So, you know, that's kind of how we position our strategy. We're not really trying to guess what's going to happen the next day and the day after. Human nature has a tendency want to guess, want to know, want to price in the future, even though the future hadn't occurred yet. And as we all know, the future can change just on a moment's notice, or in this case, on a Trump tweet. So we let the markets tell us what it wants to do, and then we react to that. And we're just very, very leery of what I'm seeing out there in some of the press and the media. I mean, even on the same show, you'll have one guy saying gold's going to 3,000, another guy saying it's going down to 500. So give me a break. You know, so sorry for this brief commercial, guy, folks, if which I rarely do, if ever. But you know, sometimes I just see what's peddled to the masses via some of these media outlets, and you know, quite frankly, I can only laugh at it. You know. But anyway, getting back to the original topic, June's going to be a key month for us. It's going to kind of be where the summer months start to unfold. You know, we're currently we're about 7% off all-time highs, as you can see on the chart here. I got the E-mini S&P 500 futures up there. And, you know, there are a couple of key areas that I've got that I'm going to point out on the screen. Then I'll show you a pattern here that everybody seems to be talking about. But you can see we've broke now this is an EMA moving average, not an SMA. And if we look at the SPX on the SMA, we've also broken that as well. So the yellow line is the 200 EMA, the red line is the 50 EMA. We've broken them. We're coming down to this shaded zone down here, which is around 27, 25. We could get a little bit of a bounce, just a little bit of what I would call a counter cyclical bounce. And, again, anything subject to a Trump tweet or any kind of tariff issue near term. But longer term, we probably want to settle in at a lower price. I was telling our members here, anywhere from the 2650 to 2750 is where I think it's a 100-point range, but that's kind of where I think price is going to settle in. We can overextend to the downside, of course, just with that, as I was saying, the adrenaline of the short-term rush of moving down lower. But that's kind of where we're sitting, and this does not surprise me. You can see this yellow bar here is value over price. It's where the most volume took place at price around 27.92, roughly, just slightly below the 2800 level. Now that was a key level for us, but it broke. So that told me right away that that's kind of where we're going to be heading down to. If I were to put this pattern on the chart here, let me just kind of draw this line here, right at that value area. And it just so happens that value area, not a very straight line, but you guys would get the idea, right? You can see the perfectly horizontal head and shoulders. There's the left shoulder, there's the head, and here's the right shoulder here. And it just so happens to sit right on that value area. These value areas are very important because the only thing that can move price up or down is more volume buyers or more volume sellers. At the end of the day, no matter what indicator you're using, it's price and volume. That is it. So if you break things down to its most simplest form, it's nice to know where all the volume is taking place at price, and that tends to be a support element or a resistant element, depending on where you are and where you approach in that area. In this particular case, it was support until we finally broke right here. Now we're just below this. This is called a neckline, right? For those of you technical chartists out there. And the typical measuring objective is from the peak of the head, which would be the all-time highs, to the neckline down here. And just doing a quick back of the thumb measuring, it puts us right down in this area down here, okay, right around 26.25. Now, I've been saying 26.50 to 27.50, but that would be the clear break. Now, typically when you have a break of a very strong support area, you have a retest of that break. That happens more than 65% of the time. That would suggest a little bit of a bounce next week. Now, we've had 6 weeks in a row of down market on the Dow, not quite as many on the S&P, but still a number. So a little bit of a counter move cyclical higher in this oversold market would make sense. But at that retest, it's going to be a come to Jesus meeting where either we move above it or we retest and fail, and that would be an area to add more shorts. Expecting us to come down, probably hold up here around the 27.25 to 2700 area a bit, and then come right on down to the into the 2600 area. So that is kind of what we're looking at now for our members. I've had all of our members hedged since the end of April. All right, we had some great charting that we do for our weekly market watch every Sunday evening, and we follow it religiously. I review it every week. It's not a chart that you need to look at and trigger a trade on a daily basis, but on a weekly basis, it's really good to know, should I be leaning bullish or should I be leaning bearish or should I be neutral? And that started to turn bearish about the third week in April, which is when we started picking up hedges. Remember, insurance is always cheapest before the storm hits. When the storm hits and the floods are up through your basement coming up through the first floor is not the time to be buying insurance, folks. So we were picking up some really good hedges in the market early on, and we've done very well with those hedges. In fact, this week in our portfolios, we were up almost every day, even though we were making money when the markets were going up and going down. Like I said in my initial rant, we're not really trying to guess where the market's going to go. We got a pretty good general idea, and we've got an edge in how we put these charts together to see where the markets are going. But we use options and a combination of the options derivatives on both commodities and equity markets to give us a way to play the markets and react to what the markets do, up or down. So that's a little bit about what we're doing here. And members, we took off last week because of a Memorial Day weekend here in United States. It was also a holiday in Great Britain. And we got a lot of international players that were trading, but as you guys know, I'm in the U.S. base, so I took the weekend off. But this is where we're looking right now for the markets. If I put it on a weekly chart, let's just step it out just a bit. You're going to see right here, down in this bottom area right here, around the 2650 area is another major volume area. Again, going back 90 weekly bars. All right, this takes us all the way back to the Q4 of 2017. This is where the most volume has taken place, right? Right around 2650. So that's why I believe the 2600 to 2650, the lower end, I said 2650 to 2750. But that is going to offer up firm support. Now it's well north of the lows that we made in December of 2018. If you guys remember, going into September of 2018, the markets were up for the year, and then it went into the red just in Q4. And then we got long again the end of December and played this move here really nicely. And most of this move, though, from about the 2600 level down to the lows of 2316 was a Fed-induced error in raising the rates. Jerome um, uh, Powell, as we call it, Power Ranger Boom Boom Powell, really screwed up in December. And then he kind of did a mea culpa and said, my bad, in early January and reversed course. And then we had this huge sell off right here. And this sell off was caused when he came out and said quantitative tightening is still on autopilot, hiked the rates 25 basis points and said for 2019, rates are due to go up another 50 basis points throughout the year. And that was in December. And you could see the markets just didn't like it. And he didn't wait very long to come out and say, oh, my bad. Oh, my God. So now the markets are really trying to put him up in a corner and force him to cut the rates 25 to 50 basis points. In fact, there's about an 82% chance, as I said earlier, of a potential rate cut of 25 basis points before the end of this year. Remember, the lower the interest rates go, it tends to support an asset bubble because money has nowhere else to go. And a lot of money has to be in the markets. So if it's got to be in the markets and the dividend yield and the returns on the S&P are better than what you're going to get holding a 90-day T-bill, that's where it's going to go. All right. So that's kind of where we're sitting right now in these markets. So net, I believe lower is the higher probability move, not higher. Now, if we look at the Russell, because the Russell, many people go, well, how come the Russell is going down, even though most of the earnings in the Russell are US based and not subject to tariffs? But what's happened with the Russell small cap to mid cap technology and a lot of other companies is more and more they've gotten very good at buying offshore. They've made it easier, technology's made it easier for even the smallest manufacturer or the smallest service company to use outsource services to buy things and then resell them, restock them, and buy them and use supply chains. So supply chains have gotten much more sophisticated. Supply chain logistics has really kind of come in a lot. Now, a lot of their sales are U.S. based, but they source a lot of their materials offshore. But you can see here, the Russell, we did not make new all-time highs in the Russell. If we come out to a weekly, you'll see here in the Russell, we never did get to the all-time highs. The all-time highs were made in September, and the Russell, if you guys recall, especially for our members, we saw it coming because the Russell started selling off before everybody else. Now you can see the Russell here didn't quite get up to where I thought it would go, which is around the 1634. Missed it by about 10 points. That's where I thought it would hit. Missed it, and now we're coming back down hard again. If we look at the E-minis, you can see here in the E-minis, we did make new all-time highs right here, okay? right over here. So, and a lot of people are saying this is just an elongated topping action because market peaks at the end of a bull market don't happen overnight, they happen over time. And you can see we're now currently below our January 18 peak. Our September, we made higher highs, and we made higher highs here. So I think this right now, the markets are not in a mode of going bearish. I don't see a recession in 2019, possibly even 2020 if they get these trade tariffs worked out. You'll see the markets. This could end up being a great buying opportunity for just about everybody. We're not there yet, but let's just see. Remember, markets run on adrenaline and emotion a lot, and there's a lot of rat brain traders out there that just don't know what the hell they're doing. And a lot of money, and surprisingly, a lot of big money that just tends to chase this via the algos. So they tend to exacerbate the movement up and down on a near-term basis. But we're smarter than that, and we like to make our money off of rat brain traders, and that's kind of what we've done, and we've done very well at it. So you can see here, I do believe that if we get a consolidation here, we'll get some buy signals. Now, will that mean we'll move back up to all-time highs? I don't know. But unless we make new all-time highs sometime this year, then I think the bull market is done, and then we're going to trade in a range before we finally give it up in 2020 or 2021. Okay. If we look at NASDAQ took a big hit on Friday. You can see here on the daily chart, we're below the EMA on NASDAQ. You can see the value area here was at about 73.61. If I put it on the weekly chart, so if we increase the time frame of the value area, notice there's two of them. There's one up here at about 74.21 and another one down here at 67.50. So to me, the 67.50 area seems like a natural target where a lot of volume was equal in buyers and sellers. Both of them, both NASDAQ and S&P above the 2018 close so that we would stay in the green, and then we're going to consolidate a bit. All right, and then we're going to move from there. So that's a little bit about what I'm seeing across these. And of course, if we look at the Dow, let me get the Dow futures up here. If we get the Dow futures up here, you can see we hit my target here. We did not, just like Russell, make new all-time highs. We came close, but we haven't. So the Dow and the Russell are the only two indexes that did not make fresh all-time highs in 2019. We made a 2019 high, but we didn't make the all-time highs that we hit last September. So this could be an early warning shot across the bow, and we're also below the 50 and well below the 200 EMAs here in this one. And you can see if I take it out to a weekly chart right here. Again, you can see the value area for the Dow is sitting at 24,427. All right, so that to me seems a natural support point. We can go a little bit lower. We're in a pivot range here. A prior pivot range for the Dow. So I think we're going to stay in the green, but we're going to, again, we've got more downside action across all indexes. Any movement higher in June as a counter trend move, I would see. And then again, a Trump tweet can goose the markets, as you guys have probably already figured that out very quickly, but the markets do indicate that we want to go lower. Okay. My index of the FANG stocks, you can see here we were in this tight regression channel moving up. When we broke that regression channel, that was our signal that things are going to start to get a little bit dicey, and then we're sitting right on the 200 EMA for the FANG index stock, which really all I've got in here is Microsoft, Facebook, Apple, Netflix, Google, and Amazon, right? So I've kind of created my own index on this, and you can see it is also very weak. And if I were to put in Amazon, which is one of the stronger ones, let me just delete this thing here and just put in Amazon. You can see here, I don't know what the heck happened here. Well, that's really interesting. Let me just see here. Let me just stop my screen for 1 second. And let me get I guess it just cut me right out. Shut down. So let me just load my e-signal again. I don't know what I hit. Some combination of keys here, and it just shut everything down. But what I was going to talk about, even Amazon, the strongest of the stocks that I include in the FANG right now is Microsoft. And Microsoft is starting to show a little bit of weakness, but Amazon is challenging key support levels. And in these key support levels here, we've got to watch it very closely. Now, Amazon's been a great stock that I love to trade using derivatives here. So let me get it back up on the screen for you right here. Let's get it back up for you. So if we look at Amazon, you can see right here. Now this is the EMA. Here is the of the 50 and the 200 EMA. We're just above the 200, just below the 50. And you can see Amazon was way up here around the 1963, and now it's down here around 1774. And I've got a current position structure in Amazon that should prove out very well for me. And we've done really good at Amazon. It's brought us, thousands and thousands over, seven figures or five figures in profits for us just over the past 90 days. But you can see here where we're sitting now with Amazon. So if the techs give it up, if the FANGs give it up, then we've got to be careful because it'll have a tendency just due to their weighting in the other indexes to pull us down even more. Now, if we look at transports is another leading indicator. Look at this sucker. We did hit my target and actually made new 2019 highs, and then we just abruptly gave it up. A lot of the transports, like rail, is getting killed because of the potential tariffs on Mexico, because railroads haul a lot of freight from Mexico into the U.S. Airlines are starting to give it up as well. So that's weighing on the transport sector. And we've got to follow this because this could lead the rest of the markets as well to the downside. So these are just some of the things that I'm watching. And of course, if we look at volatility, right here, you can see we are in the yellow zone with vol. All right. It's very difficult to keep volatility up. Once we went up here on May the 6th, the month of May has just been an ugly month. All right. But you can see here, we've been pretty much elevated north of 15. The yellow zone for me is north of 15, south of 22. But even with all these gyrations, we did not get over 20. The last time we've been over 20 was in the second week of May for the VIX. It seems like it's been an orderly move. If I come back to the E-minis here and put it on a monthly chart, okay, just to show you the monthly bar, you can see this trend line that's running up here like this. And let's just blow it up so you can see a little bit better here. You can see the monthly bar, and you can see that upsloping trend line. So we can maintain a secular bull if we come all the way back down to the 24,000-2,500 area. Now that may take us some time, so that'd put us around 2,500. But you can see here just where this bar, it actually did not go below the March lows, but we did go below the April lows. And because we made all-time highs, this is a bearish engulfing monthly bar. So a bearish engulfing monthly bar signifies that we've got more potential bearishness ahead, not without a little bit of a counter move. So if we look at these and just kind of compare and contrast, I would not be surprised to have it similar to this. So there is a yellow bar here. Here is this yellow bar here. That means a change of trend on the signals that I'm using here. Then you can see the very next bar. Notice here that we traded, an inside bar. So we didn't take out the highs here and we didn't take out the lows here. We actually moved up a little bit, but we stayed within that bar. So to me, I would not be surprised to get some kind of inside bar right here, where we don't take out these highs, which would give us all-time highs, and we don't take out the lows, all right? And then after that, then we get another bar that takes out these lows, possibly March lows coming into the February lows, which puts us around this 2650 area. So that would give us the July timeframe. Now, again, I'm speculating, and as you guys know, I hate to speculate because I don't trade on speculation. We're not here to gamble. We're here to do the higher probability plays. But this is what seems to be shaping up right here. You can see the MACD is just doing this steady degradation, just rolling over, and it's been rolling over, since April of 2018. Okay, on this monthly chart. So when you get this kind of approach, this could mean, looking at this in a topping action, the odds are getting stronger and stronger that we were looking at a market topping action. But it's hard for me to define a market topping action when we have higher highs. Okay, that's not the definition of a market topping action. And we've got this kind of megaphone approach here like that. And with a megaphone, it's a rare technical indicator that shows that you can make higher highs, and it's just expanding volatility until one of them breaks. And generally, the break is generally to the downside, not to the upside. Okay, so that is a little bit about what I'm seeing here, and so we've got to be very careful here. Right now, I'm more near term, as you can tell, more bearish than I am bullish. I'm expecting either an inside bar, monthly bar for June, or some chop. As I said, June could be boom. We could have a booming June, or we can have a failure. So this is kind of where I'm watching, and it's going to be key for us, all right, as far as the rest of the summer and defining it. If we look at volatility and we look at the front month term structure, that would be the VIX compared to the June futures, vol futures, you can see right here, we're in a backwardation. We're in the red on this chart. So that means we're in a backwardation. So the term structure is backwards, meaning the VIX is higher than the front month vol futures for June. And if we go to the back month term structure, you can see we're not in backwardation. We're in a contango environment because we're in the green. So all this really means is the fear is on the front end of this curve. So that's why I think June is going to be a key month for us. It's going to be a key inflection point. Okay. Let's see where all of this takes us. Now, treasuries, I talked about yield. And if we look at interest rates, look at this, guys. I mean, we're down 2.14 in the 10-year, right? That is insane. And if we look at it on a weekly basis, people are saying that this thing can go below 1%. I mean, look at this. So if I were to move this down, we're already at 2019 lows. This is a weekly chart. And like I said, last time we saw this was in 2017, right? In Q4 of 2017. You can see this value area right here around 2.36. And that's where I think we're going to go to. I think this is a bit overdone, although looking at the MACD, there is no indication that any rally is going to be bought into. It's probably going to be sold off of. Now, if the Feds do not cut the rates, you're going to see this do this mass reversal up. But I do believe the Feds are going to cut the rates because that's what the 10-year yield seems to be indicating to me, right? And then, of course, if we look at bonds, which is the 30-year, it was up Friday over one full handle and 18 ticks. Look at this, huge. Last time we saw this on a weekly basis or at this level here was back in Q4 of 2017. Okay, right in this area here, I'm starting to get very interested in looking at shorting this thing because it's going to be very difficult to maintain these interest rates. Although the Elliott wave plot on my chart seems to indicate that we can go even lower. Okay, which is just amazing to me. But we'll see how this thing plays itself out. And then if we look at the US dollar, it was down on Friday, but we are still holding our regression channel. Now, this is a weekly chart, but you can see here, every time we get up to the blue line, the top of the regression channel, I'm more apt to go long the euro dollar. And every time we come back down low, I'm more apt to go long the dollar euro, all right? But you can see that it's going to be very difficult to maintain these high levels up here. We'll see, but money right now, the U.S. is a money magnet for international funds. The fund flow here in the U.S. is just very strong right now, okay? And then, of course, if we look at the euro, all the currencies are just screwed compared to the U.S. dollar. The euro is just the opposite. Look at that regression curve, folks. I mean, and this is on a weekly chart, all right? So this goes all the way back to the summer May of 2018. And you can see almost one full year of just going lower and lower and lower. All right, so we haven't seen these lows in the euro since 2017. All right, we're at 2011 or 1.11. I think it can go even lower than this. All right, at least near term. So we got to just stay on top of it. Oil, folks, it's doing exactly what I said it was going to do. I've been telling our members. This is a weekly chart. Let me put it on a daily. I've been telling my members here, as long as it's in this regression channel, I'm willing to play it to the upside, but oil should be in the mid 50s to high mid 50s, something like that. And sure enough, it gave it all up here. When the global economy is at risk, oil just will not go much higher. All right. I don't care what the supply demand imbalance is. Right now, you can see the value area. We're sitting almost right on a value area at 53.55. You can see this yellow bar right here. And no matter what OPEC does, no matter what Iran, Venezuela, it's just rolled off here. It came down to the area where I thought a little bit of an overshoot, but that's normal with oil. I think it's going to be in the 50s for the remainder of this year. Momentum may carry a little bit lower. This is kind of where I'm sitting with oil. Gold had a good day on Friday. I mean, it was up. As I said with gold, if it breaks this area and comes up over 1300, now my interest is peaking again. What's causing this break? What's causing this move up? Money is coming back into gold. And I'm more willing right now, not necessarily to chase it at this level. Excuse me. But you can see this upsloping trend line here. Excuse me. That we broken and we move back up. So it'll act as support right around the 1300 level, but I'm more apt to switch over to long gold. Now, silver, if we look at silver futures, it's much different than gold. Silver is a lot weaker. So I think silver is going to play catch up. You're going to see silver, if should gold continue to stay elevated. Excuse me, folks. I had something stuck in my throat. We're going to see silver move up very strong. Okay. So that's a little bit about what we got going on. I wanted to keep it brief. For members, I will see you this Sunday evening. We got some great plays that we're looking at from a stock perspective. We've got some really good strategies that we're running options wise. If you're not a member, I highly encourage you to come in. We've got, I think, our lowest offer ever this Memorial Day weekend. We've extended it a little bit. We got some interested parties, a lot of interested parties with emails and questions and stuff. So many have signed up. I hope to see you guys come in. I'm not really much on the commercial side of things, but we're doing well. And if you guys that are regular followers of my charting know that we're generally on the right side of the markets, that gives us the edge that we need. All right, everybody, have a great weekend. Members, I will see you this Sunday evening. Take care, folks. Ciao.